Olix Network 18, Mission Poshan, Bhavishya Roshan.
Well, with that backdrop of the opening trades, let's invite our market master for the morning. Neelkanth Mishra, Managing Director and India Equity Strategist at Credit Suisse, joins us now. Neelkanth, always a pleasure having you with us. Two of the things you all picked up, I think you all picked up metals 3 years ago and IT 2 years ago. Both of them are the only safe places to hide at this point in time. You will ask people to continue to invest in those two areas, stay put or book profit.
Yeah, so IT has done rather well this year. Metals, I think after having a very good start, has corrected a bit. There have been some concerns on global growth remaining slow for much longer than was earlier expected, and plus some of the stress on the emerging market side, which is resulted in their central banks raising rates sharply to protect their currencies, should also have some negative impact on growth. But despite all of that, we are remaining overweight on metals. I think the stocks have corrected quite a bit, but the fundamentals remain intact. In IT, we have downgraded a few of the names just last week, in the last couple of days, because of them being overbought and quite a bit stretched, and we haven't seen fundamental improvement. So the P derating that we had seen, which made them very attractive to us when we went overweight about a year and a half, a year back, that argument no longer applies. So we'll be very selective on IT. But yeah, in our portfolio, we are overweight both the sectors too.
Okay, still overweight IT and metals. Neelkanth, hi, good morning. Always a pleasure speaking with you. What's your view overall on the market? Would you downgrade earnings estimates for FY19 after what you've seen in the quarter gone by?
Right. So, see, the EPS at a Nifty or BSE 100 level is always tricky to call, given the significant global exposure that we have in our sort of narrower indices, the more popular ones, and also because there is a positive relationship to a weaker currency. So, if you have the rupee, and that's one concern that we continue to have. The rupee has bounced back from what I would call very precarious levels, but we still think there is a lot of risk to the currency because the balance of payment situation remains in the negative. So if the rupee continues to stay weak, the earnings for, say, the IT names, the metal names, the petrochemical names, some of the pharma names, I think they naturally get upgraded. So, that linkage aside, we have seen a 3.6% correction, rather cut to FY19 EPS after the results season, the March quarter results. The year-on-year growth now is 34% in FY19, which looks very high, but that's because there are a lot of one-offs in the FY18 base. Okay. But I still think that we will end up at 25–26%. So by and large, I mean, some cuts will continue, but hopefully not at the pace at which we saw them in the March quarter.
25–26 is a damn good number, Neelkanth. I mean, can we expect that kind of an earnings growth in spite of the pain,
no, but see,
continuing pain? Yeah, sorry.
Yeah, so see, on the banks provisioning, you know, so there were 65,000 crores of provisions booked in the March quarter. So unless we expect a similar quantum to really destroy, I mean, so you know, so the FY18 growth was 7–8% till the time that the fourth quarter results came, and then because of some of these massive losses, it has actually gone negative. So if you adjust for that and assume that perhaps because of that the FY18 numbers are 6–7% lower than they should be, then at a 25% growth that we now think FY19 will settle at, we're actually talking about a 17–18% growth, which is not that aggressive. Maybe you know, we could be 2 or 3 percentage points more aggressive, but because of the low base of FY18, the headline for FY19 will look strong.
Okay. You identified metals and IT for us well in advance. Tell us from here on, where do you see potential now for value? What sectors would you be overweight on?
That's, I mean, almost everything looks overvalued at this stage. See, the problem is that India should continue growing at 7%, right? So I think the GDP growth, so when people are bearish or bullish, I mean, we are talking about the second derivative on GDP growth, that is, on GDP, that is, should growth be at 7% or 6.8 or 7.3, 7.4, where consensus is at. We are of the view that that's most likely going to be 7%. I think there's been a lot of excitement around concurrent indicators showing very strong growth in the March quarter, and perhaps even the wholesale sales of autos in the month of May have been very strong. So these indicators have, I think, caused a lot of excitement among some. We think that the economic activity momentum may have peaked, maybe a couple of months back. There are headwinds appearing for economic growth. They have, right? So if interest rates have gone up, and not just bond yields, which of course finance a very large part of incremental lending, but that's where a large part of incremental lending is anchored to. We've also seen deposit rates start to go up. We've seen lending rates start to go up, and these are natural tighteners. We've also seen oil prices go up. Now, see, $1 per barrel is $1.1 billion a year, and that's a reduction in income for the country. In this case, this is being transferred straight to the consumer, which I think may be the most prudent thing to do for the country as a whole. And but without being prescriptive, this is what is happening. And as it happens, I think the incremental attractiveness of buying a two-wheeler or a four-wheeler, I think, starts to go down. It also starts to bite into other forms of consumption. So that's another headwind to growth. And if you notice, even in the March quarter, where the headline growth was very strong, overall consumption growth was not. So, and this is in a quarter where almost every company that we track in the stock markets was reporting very strong numbers.
Yes.
So, and this reflects the reality, and a very sad reality, that a very large part of income of India is not seeing income improvement. And contrary to how the narrative is being spun around rural incomes, my sense is that on aggregate, rural income growth is not very good.
Oh, I see. Well, some of the volume growth numbers, say for a Hindustan Unilever, looked good. But I just want to scratch the point on earnings growth a little more. Have you factored in the tightness in the interest rate in the financial markets? The fact that yields have gone up so much, almost 140, 150 basis points year to date. In spite of it, you think they will deliver 24, 25%?
Right. So I think the mark-to-market has been seen, right? I mean, unless yields move up another 50, 60 basis points from here, I think from a reported earnings basis, the mark-to-market has been seen. I think the companies that drive a very large part of earnings for Nifty or BSE 100, which are the private banks, they have a lot of pricing power. Almost 2/3 of PSU banks by number are in PCA. I mean, 11 are in, and maybe 3 more may go in. And so you are seeing a shrinkage in banking capacity that gives a lot of pricing power to the banks that still can lend and have the balance sheet. And so they can keep raising deposit rates and they keep raising lending rates and maintain or maybe even expand their margins. So I think we have to differentiate between what is important for the economy and what is important for the markets. Okay. Now, coming back to that point that you mentioned about some large staples companies seeing good volume growth. See, last year we had put out this note. In India, if you plot category-wise growth, or you plot a chart where on y-axis you put price growth over 15 years. On the x-axis, you put volume growth over 15 years. And every dot is a sector. So the chart looks like this. I mean, so this is your y-axis, this is the x-axis. The chart looks like this. So here you have cigarettes, where price growth was 11%, volume growth 0. Where here you have toothpaste, where price growth was 0 and volume growth 10-11%. Everything is at or near this line. Now, in the case of some of the staples products, when GST rates have fallen from 28 to 18, that price cut has been effectively gifted by the government. I mean, it was necessary, but the point is that it has been done, and therefore, many of the staples companies are benefiting from that. So I won't extrapolate it to saying that. See, like tractors, for example. Tractors, there are massive numbers of subsidies being given.
Okay.
Right? It's a 35,000 crore market. For it to grow 25%, you need 7,500 crores. Every state is giving subsidies.
Okay.
So while we are positive on the tractors, it is wrong to extrapolate that data point to saying that, oh, there is a massive rural recovery.
Fair enough.
But that is actually a scary situation to be in, considering the way the stocks have rallied, right, Neelkanth? I mean, most of these stocks, I'm not talking about tractors particularly, but even the Britannias of the world, the Nestles, are all sitting at new highs. If there is no real consumption, you think that it's a risky place to be?
So we are underweight staples. I mean, not mention specific names. There are sectors where we think there is a structural change happening, and we have been very positive, for example, on packaged food, because with this data, the spurt in data use, the spurt in data users, the supply chain complexities which prevented packaged food from really expanding, I think those corrections are trying to happen. The cold chain is expanding. So there are other structural changes which are happening, which allow some of these companies to maintain their volume growth. But yes, I mean, if the assumption is that the March quarter or the December quarter, it has started to show up in December quarter itself. So if the last 6 months of sales growth will continue for the next several years, I think those stocks are very expensive, which is why we are underweight staples in our model portfolio.
Okay. Okay, let's talk about something cheerful. Your report, which landed in our inbox today, indicates that you're extremely positive on how data has gotten very cheap. And let me just quote one number which stands out. Credit Suisse estimates that by 2020, there will be 550 million Indians with data video capable phones from just 200 million at the end of 2016. Now, what does this mean for a stock picker? Does it mean advertising reaches out? I mean, what does it mean for economy and investment?
Right. So I think I see these are very early trends. This is meant to at least start to create a framework. It took us 3-4 months to work on this report, because even the industry, which is right in the trenches, seeing this happen, is still trying to fathom how this changes people's behavior. So we've tried to create a framework around how this affects the economy. I think translating that to stocks is another art form, and perhaps I can mention sectors. The broad indicators, I mean, as you rightly said, the brand building opportunity improves. So one very large company whose board I was presenting 5 years back, our silent transformation report, they said, look, it's great that rural roads, electricity are all helping, but till I can get my brands on TV in front of these families, it doesn't benefit me. Now what this does is that what cheap data does is that in the next 2 years, it will, by the end of the next 2 years, it will expand the consumption that can be targeted with video advertising from just about a quarter, about 27%, to well over 95%. So that, I think, creates enormous opportunities for getting branded products through the door. It also allows for niche brands to develop. I mean, the other day, someone was saying that Facebook or some internet companies can offer 600 or 1,000 rupee advertising packages. Okay. These are things which were unthinkable in mass media, and this allows for a lot of creativity, a lot of business activity. But more importantly, on the worker side, I think it significantly improves utilization of our informal workforce. It brings down inventory to GDP ratio in the economy. For us, at 23% of GDP, India's inventory to GDP ratio is by far the highest in the world. There is a lot of useful capital locked up in there. And as that comes down, yes, and this is because of inefficient supply chains. We have a very fragmented retail chain, which does not have much access to supply chain information, and therefore keep unnecessarily high inventory, because their replenishment days are very spread out. It's called an inter-arrival period in supply chain lingo. These are very large, and as they get connected through smartphones, I think inventory levels will go down. And I was talking about packaged food. Some of these businesses, which have very short shelf life, cannot survive with in an inefficient supply chain because the wastage will be too high. But those businesses now become capable. And lastly, on the services marketplaces, you know, the utilization of a car, the utilization of a hotel room, the utilization of a carpenter, an electrician, a beautician, these all things start to accelerate as data reaches more than 95% of India's workers. So I think these are very exciting story. So structurally we remain quite positive on India, but I think our concerns around a near term, as I said, the second derivative doesn't look that good, at least for the next 6 to 12 months.
Okay, that's a very comprehensive, long-term optimistic story. Neelkanth Mishra, it's always a pleasure listening to you and getting some brave new ideas for a brave new world. So not much money right away perhaps in stock markets, but this is a great long-term growth story. Packaged foods, I'll remember that, perishable packaged foods. Thank you very much, Neelkanth.